Hi to IPO subscribers. Welcome to eagleye.ai. Today let us review main board IPO from LUMINO Industries Limited. Here we go on IPO review. This is the financial performance and status of the company and generated by AI powered software. And here the company has been categorized as an unhealthy company, which is totally wrong. Company is a healthy company that we will discuss now itself. So now we go to health analysis, solvency. Solvency and liquidity decides the health status of the company. That is whether the company is healthy, unhealthy. That is the decides. So here, what are the factors we take is in a metric in solvency or liquidity, they are negative. The software, what it does, it classifies the company as an unhealthy company. Here, what happened? The net worth to assets ratio, it should be 0.34 plus. And debt to assets is 0.66. Here it is 0.66. And here it comes to 0.33. Total should be 1, but it is 0.99. That is the reason why this company has been categorized as a unhealthy company. Otherwise, just for 0.01, this company has been categorized as an unhealthy company. Otherwise, the company is a healthy company. So, liquidity, very good. Current ratio is 1.39, quick ratio is 1.13. And coming to operational efficiency, negatives are there. And this will be changing from time to time. So, it's not the fixed one. This will be changing from time to time. So this we need not consider. And coming to financial irregularities, so no financial irregularities have been identified. So no financial frauds or financial irregularities. Good. Profitability, EBITDA 287.22 and EBIT is 270.8 crore and PBT is 204.8, PAT is 159.26. Cash profit is 175.68, EPS is 6.57, EBITDA margin is 13.74, net profit margin is 7.84, ROC is 24.22, and ROE is 24.61, very good. And coming to book value per share is 29.95, okay, not a small amount. But here, cash flow from operating activities is 156.08. And net cash flows for the year is 13.76 crores. So coming to market value, 82 rupees is the cap price of IPO. And based on that, price earning ratio is coming to 12.48, very good. Within a benchmark of 12. And coming to price to book value also 2.73. So valuation point of view, this company appears to be good. And because it is less than benchmark levels. And coming to growth indicators, except sales growth is 7.32 and all other metrics are positive. So this is about the financial analysis of the company. The company is a healthy company. The company is a healthy company. And now we go on IPO review. This is the IPO review. LUMINO Industries Limited. Attractive valuation, but can cash flow deliver? The question has arisen that we will discuss later. The company combines manufacturing plus EPC in India's power transmission and distribution sector, giving its exposure to one of the country's important infrastructure theme. But while the valuation looks attractive, investors need to look beyond EPS and PE because 288.79 crore of aging receivables is a key risk. These key receivables are due for more than 6 months to 3 years. So that is the main reason. So coming to business overview, what does the company do? So integrated engineering, procurement and construction EPC player, manufactures and supplies conductors, power cables, electrical wires, specialized electrical components, manufactures HTLS conductors for transmission and distribution network. provides integrated design plus engineering plus manufacturing plus EPS. So service multiple sectors, power transmission and distribution, renewable energy, industrial infrastructure, railways, communication and electrical panels. More than 30 years of industry experience, financial year 2026 operating EBITDA margin was 11.71%. Industry opportunity, India's transmission network continued to expand, supporting long-term demand for conductors, cables, and related equipment. India's transmission network reached about 5.02 lakh circuit kilometer by January 2026, according to CP5 prospectus. Sector outlook positive. Power infrastructure plus renewable energy integration is equal long-term demand opportunity. Good. IPO structure. 700 crores is IPO and the component amounts. Say fresh issue is 500 crores, YFS is 200 crores, total is 700 crores. So use of fresh issue, 337 crores debt repayment, 15 crores is the equipment. That means most of the about 150 crores is going towards capital expenditure. The amount appears to be a little bit higher side, almost 150 crores. 500 minus 337 minus 15, so no, 135 crores. Yeah, somewhere 135, 337, 15 means 160, 150, around 350, 150 crores goes to the capital expenditure. So general corporate expenditure, it appears to be a higher side. It's a public money, sir. Simply how they can use 150 crores for general corporate purpose. Careless, what to do. So they are using debt payment, debt repayment can strengthen the balance sheet and potentially reduce the interest cost. And but 200 crore is a YFS, so that amount goes to selling shareholders rather than company. What is the company can get here? See, they are using almost 336 crores for that 337 crores for debt payment. There, the company can save net interest of, that is after tax of about 26 crores, or I can say 25 crores. And coming to 15 crores equipment, their return net worth is about 24.62. 24.62 means against the 15 crores, they can save about 3.5 crores. So net the benefit to the company, yearly return to the company because of this IPO, as the money is going, all the money is not going to the company. 1 500 crores are going, and that out of that, some the 360, 315, 3, sorry, 340, 342. Yes, sorry, 352 crores they are using for company purpose. Against that, the company is getting around 140 crores they are using for corporate expenditure. So against the company can get a return of 28.5 crores. So the yearly return to the company from this IPO funding is 28 crores. If you think it is a good return to the company, that will give you some good returns to the investors, and that will give some good market price, and you can go ahead. Or if you think the amount is lesser amount, it's up to you. So that is the about return on whatever the funding they raise. So verdict is positive for deleveraging, but not a pure growth capital IPO. Yes, it's not a pure growth capital IPO. Valuation. The key highlights is valuation looks attractive. At the upper price band, 282 rupees. EPS EPS 6.57, price earning ratio 12.48, PB 2.73. But valuation is very good. Based on the stated growth assumptions, projected PE is 9.18, projected PB is 2.10. Right? So valuation point of view is very good. Why the valuation stands out? Current PE 12.48, projected PE is 9.19. If the company actually delivers the assumed growth, the valuation could become even more attractive. Very good. So valuation verdict, attractive. In the current IPO environment, this is important because investors have become more selective about valuation, earnings quality, governance, and cash flows rather than simply chasing IPO momentum. So one must be smart enough to invest in any IPO. So the big question, cash flow. Why cash flow? The company is having book debts more than about 6 months to 3 years is of about 288.79. So if not today, the other day, the company has to write off this 282.79. This year they have provided provision for about 64 crores. That is due for more than 3 years. So this is the reason why cash flow is having impact. So don't treat it minus 28.79 is not, suppose if it is debited to the P&L account, what will be the company profit? So receivables, when it comes to receivables, it appears the company is not getting the in-time collections. More than 6 months, their book debts are almost, I told you, 280.79 crores. So receivables outstanding for more than say, 6 months to over 3 years. This is the single biggest concern in the investment story. And that is the reason why the cash flow is concerned. The company may report attractive earnings, but investors should ask, are those profits being converted into cash? So high aging receivables can increase working capital requirement, collection risk, financing requirement, cash flow pressure. Yes. So if they cannot collect the receivables in time, that will have serious impact. They have some receivables problem, collection of receivable, realization of receivable problem. They have some problem that will have its own impact on the regular operations of the company. Cash flow risk, attractive PE, not equal to automatically attractive investments. Okay. Attractive PE not equal to automatically attractive investment. Promoters and governance. Positives. Promoter holding 100% pre-IPO. Expected post-IPO holding 71.97. Experienced management, more than 3 decades of industry experience. Concerns. Related party business in the same sector requires monitoring for potential conflict of interest. This may not be taken seriously because number of people are there. Only thing is these people are supposed to be relatives, otherwise, okay. This on this point of view, in university, don't worry about it. Governance we watch. See why they because they are not able to collect the receivables in time. That is the problem, main problem. Key risks. Aging receivable, 280.7 is a major risk. Competition, aggressive bidding from established players and new entrants could pressure margins and order bills. Statutory dues, delays in certain statutory payments require monitoring. YFS component 200 crore does not come into the company. All the money companies to the selling shareholders. They're going to get some good amount of profits. And if you are there to give them some good amount of profits, then it is up to you. So execution risk. EPC projects can face delays, cost escalation, and working capital pressure. So that is what. Market sentiment. IPO market active, but investors are selective. India's IPO market has remained highly active in 2026. Recent data shows strong equity fundraising and renewed IPO activity. But investors are increasingly discriminating between well-priced business and expensive or low quality issues. August 26 has been particularly active with IPO fundraising reported exceeding 21,000 crores across 20 companies, highlighting strong primary market activity. Of course, it is strong. However, the broader market backdrop is not risk-free. Global uncertainty and heavy IPO activity can absorb liquidity from the secondary market. Of course, that risk also will always be there. For the IPO, investors scorecard. Business model positive, industry growth strong, manufacturing plus EPC positive, EBITDA margin reasonable, PE 12.48 attractive, PV 2.73 reasonable, projected PE 9.18 attractive, debt repayment positive, promoter holding positive, aging receivables risk, cash conversion key concern, and competition risk and governance watch. So So final investor review, our review, cautious, subscribe. Why consider it? Why consider it attractive 12.48, good valuation, reasonable 2.78, 3 PB, potential 9.18 projected, and strong power infrastructure opportunity, renewable energy tailwinds, integrated manufacturing plus EPC model, 337 crores debt repayment, experience from models. Okay. So why remain cautious? 288.79 crore easing schedules, cash flow conversion needs monitoring, competitive EPC environment, related party business exposure, statutory payment delays, 200 crore YFS amount. Closing script. The IPO offers an attractive combination of valuation and exposure to India's power infrastructure growth story. At 12.48 times per earnings, the pricing looks reasonable, and the projected 9.1 times P makes the valuation even more interesting. But there is one important warning: 288.7 crore of aging receivables. And so investors should not evaluate this IPO based on EPS and PE alone. I told you, no, the company will have around 28 crores of returns from this, whatever the money company is receiving from the IPO. So 28 means, suppose they rate of 288.79, that means 10 years of this 28.5 crores, whatever they are going to earn from this IPO, that will go to this 288.79 crores, the company what has to write off. Finish. There will not be any additional profit. Total debt again, it is whatever they get from the IPO amount, that will be adjusted to 288.7. This will be profit, that will be expenditure, both together minus. So now you have to think on that. Final verdict, cautious, subscribe, attractive valuation, but can cash flow, delivery. Valuation attractive, business positive, market sentiment positive, selective, risk moderate high. Best suited for investors comfortable with a moderate risk who are willing to monitor cash flows, receivables, and post-listing execution. I told you, the final amount what I can say is whatever the profit they are going to have from this IPO funding, that is 28.5 crores, that will be adjusted towards the receivables they have to write off over a period of 10 years. That is 288.78 crores. Okay. Thank you for watching. And if you found this analysis useful, please like the video, subscribe to the channel, and stay connected for more detailed IPO and stock market research. Thank you.